View right now is that you're going to see a softening of the economy. People talk about the impact of tariffs, but the fact is that they filled up the warehouses. Then you're going to have a 4-month hiatus in terms of goods moving to the country. That will affect small and medium-sized businesses. And some of the data that you just spoke about, right, which is the FedEx doing less well in the market, energy prices down, are all indicators, right, of a softening economy, slowing of the economy, and we're going to see some unemployment of hourly workers coming up in front of us. That is what the institutions see. And they see that carrying on into 2026.
Right, and then retail is just like, we're conditioned to buy the dip. We're going to buy the dip. But retail is not going to be enough necessarily to lead us for another leg higher, right? So what do we need to see for that? Yeah,
so I think what we need to see is much more clarity about economic policy, both in taxes, and then we need to see what forward earnings are going to be. And we have to remember that we're only about 6 or 8 weeks away from those 2026 projections. Companies have been very loath to give us any real indication. They've actually pulled back earnings estimates. So that's what we're going to be looking for, and I think we're going to need to see the growth companies continue to power ahead, especially in AI-related implementations. That's going to be a big indicator of whether or not forward investment and capital investment continues into 2026.
Do you think, though, the economic conditions are going to be conducive to that?
I think the answer is maybe, and I think we're going to have to see basically a stopping, of the government's tendency to muddle into all of these things. Tariffs themselves are just a tax on the consumer at the end of the day. And so long as we have consistent policy, the tax bill is passed, we can really digest that, and then people have to decide if they can make the investment. So I would say the jury is out, and I think it's leaning to the negative right now.
There's a broader issue, though, also about just sentiment and the way people view the U.S. economy right now, U.S. policy, and in tune U.S. markets. And of course, a lot of hay was made about the Moody's downgrade, and we can debate whether that was the lagging indicator or not. But it's certainly something that everyone was talking about long before Moody's finally decided to sort of weigh in on this. The idea that deficits are getting too high, that's going to lead to higher borrowing costs, lead to higher inflation, and that will tamp down growth.
But when you look at what was talked about on Bloomberg in November and December of last year, it was all about U.S. exceptionalism, and that is gone. And so the idea of the U.S. leading in terms of the world economy, thinking globally, is gone. The whole idea of a stronger dollar is gone. So we're talking about an entire different regime change that's coming up, right? And what investors have not done is to begin to move money into international markets, to Japan, to China, right? Into Europe to a small degree. They have not done that. They have not diversified their risk even in the U.S., adding digital assets or anything to their portfolios. So I think that the investors are just not anticipating what is going to happen in 2026.
Yeah, but on the same side, we wind up getting FOMO. In the U.S. Like, if that had been the thesis a few weeks ago, you would have missed, like, Microsoft's earnings and what happened with Meta. Like, a lot of the tech companies are still going gangbusters here, and you can't miss that, and that leads to its own sort of FOMO. How do you do both?
So here's how you do both. You think about portfolio quality. So this rally that we just saw had a lot of very poor quality companies, highly shorted companies that needed to have short covering, and that was a big part of the rally. And so what you just said is very important. Our clients need to move money into the highest quality securities, those with the biggest moats, the most likelihood of succeeding under this economic regime. For small and medium-sized stocks, there's much more risk today, and that goes for global companies as well. So I think portfolio composition is going to be the key to success as we go into 2026.
So how active then, oh my God, 2026 feels like so far away. How active then do you need to be?
I think you could see a portfolio shifts of 10 to 12% of entire portfolios now. Into specific sectors. That is a lot compared to a normal year. Into specific sectors, right? You talk about U.S. tech, but it's got to become international tech, including some exposure to China. We've got to look at the finance sectors in the rest of the world as very attractive investments coming up in 2026. All of these are going to be beneficiaries of these changes of policy.
And we have to just ask you, though, when we talk about the big structural themes, particularly that drove the rally last year, which was AI and all the tech spending in that, and you kind of alluded to this earlier about a continuation of that. Is that going to be a global story, though? Because it's been driven by the U.S., the U.S. companies.
We're going to move from this idea of the story being the investment in infrastructure and data centers to the investment by companies in upgrading their own technologies and implementing them in their businesses. And what we want to see are companies that are driving higher earnings growth by the use of AI, which should become the theme in 26 and 27. That has not become clear in the earnings so far. Right now, it's all about the investment. And so we're going to see that translation in a bunch of service businesses.
All right, David. Great to catch up with you once again. David Bailyn is the CEO of the CIO Group here in Studio 2, counting us down to those closing bells. Those bells now just less than 3 minutes away here. Most of the major